Okay, so hello guys and welcome to another video, and for today we're going to talk about daily price profile symmetry. Now, on the last video we actually introduced the concept of daily price profile symmetry, or went in depth in terms of our explanation of daily price profile symmetry. So what we're going to do here with this video and the next two videos that should follow after this one is we're going to talk about specific instances where we apply the protocol, right? So we're gonna talk about how we apply the protocol, and my goal here is to explain the protocol in terms of how we utilize daily price profile symmetry. And at the end of the video, so what we're doing here is we're just going through each individual concept that we're talking about, each individual protocol. And at the end of the video, we're going to do a PDF or a blueprint or a summary of the entire trading model, right? Which would be summarized, right? Because we've essentially explained each of the concepts. So the reason why I am taking my time with the videos is because I want you to fully understand each of the protocol and also each of the concept in depth. So that way, when we do talk about the full on just trading model, you have a clear understanding of what we're talking about. Now, we're going to talk about a very specific instance where we apply daily price profile symmetry for our trading protocol. And in this instance, we're strictly focusing on trend exhaustion, right? So we're focusing on how to utilize daily price profile symmetry to measure the probabilities of a trend exhaustion, aka weakening order flow, right? Or a trend continuation, which is where you see higher time frame sponsorship. So typically a trend continuation leads to higher time frame breakouts, right? So that's where you get a classic trend continuation, which is strengthening order flow. And the last part is establishing daily reversals. So of course, what we're going to do here is we're going to work on the first scenario, which is trend exhaustion or weakening order flow. And then on the next two videos, we're going to talk about trend continuation. We're also going to talk about trend or establishing daily reversals. So essentially, how can you confirm if a reversal is high probability reversal or low probability reversal, right? So what we're going to do here is we're going to explain the concept of daily price profile symmetry, and we're also going to rehash some points from the last video, right? So we derived the concept of applying price profile symmetry because we have an understanding of market delivery. And that understanding of market delivery essentially is that in an institutionally sponsored market, the market would reflect liquidity across correlated asset classes. We anticipate the market symmetry or the lack thereof to anticipate institutional flow. So we can kind of determine when there's active institutional sponsorship. If there's active institutional sponsorship in an asset class, typically what you do get with that is you get price symmetry. So you get a situation where if there is higher time for sponsorship or institutional sponsorship on euro dollar, for example, you want to see that liquidity on euro dollar be reflected on cable. You also want to kind of see that be reflected on Aussie dollar and also New Zealand US dollar, and of course USD CAD, because we're seeing huge inflows of liquidity into euro against a dollar. So that means a strengthening euro and a weakening dollar. All right. So if we have a situation where we have enough of institutional sponsorship, institutional participation, unidirectional. So unidirectional meaning in one direction, we have institutional pressure in one direction. That will reflect across different asset classes, especially correlated asset classes. Now, here's the thing. When we see that lack of correlation between supposedly correlated asset classes, that typically indicates that we're no longer seeing a strong institutional sponsorship. So we're seeing a lack of institutional sponsorship. And that's so crucial. That is really crucial to anticipating the likelihood of continuation when we see the market trade up or down into higher time for liquidity pools. And it kind of like gives us insight as to are we supposed to expect continuation after we trade above a liquidity pool, or are we supposed to expect kind of like a consolidation, possibly to a reversal, right? So the beautiful thing about daily price profiles is we can kind of anticipate what comes after. And I'm going to show you with just two examples how we can apply this to our trading model. Now, the first example here is we're applying daily price profile symmetry to anticipate trend exhaustion for a higher time frame external liquidity pool. So our focus for today's video, which should be pretty shorter than the other ones, is we're focusing on higher time frame external liquidity pools and higher time frame internal liquidity pools. All right, so for each of the topic, I'll do a bit of a breakdown on the concept essentially. The first protocol is for higher time frame external liquidity pools. And when we talk about external range liquidity, now we've talked about this on the course. I think this was probably module 3 of our beginner course, training course, or introduction to institutional concept. And when we talk about external range liquidity, we're essentially talking about liquidity that rests external to a predefined daily range, right? So that comes in form of highs and lows and rejection blocks. So when we talk about external range liquidity, we're strictly focused on highs and lows and rejection blocks. When current market price is at or above daily or weekly bullish rejection block. Now remember, this protocol is strictly for higher time frame analysis. This is not for lower time frame analysis. All right, so we're applying daily price profile symmetry for our high time frame analysis to kind of like give us insight as to, are we trading in a high probability market or are we trading in a low probability market? So when we have a situation where current market price is trading at a rejection block, be it a daily rejection block, a weekly rejection block, or an old high, daily old high, weekly old high, this is a point where we no longer take trades, right? So the moment the market trades into a rejection block, we're not taking trades anymore. We're not taking continuation trades, right? That's the main thing here. So what we do here is the moment we see the market reach either, again, it has to be an higher time frame. If we see the market trade into a higher low on the higher time frame profile or a rejection block on the higher time frame profile, our model calls for us not to do anything. And this is where we begin to assess. All right, so what are we looking for? We're looking for signs that the market should continue after trading through that liquidity pool, external range liquidity pool, or we look for signs that the market should not see follow through after trading through that external range liquidity pool. So this is where the concept of daily price profile symmetry comes into play, and this is where it becomes actually really crucial. So essentially the summary of what we're talking about here is if we do a comparison between our reference assets. So in this example, we can assume our reference asset is $1 and our comparison asset would be an asset like T-bonds, for example, right? What we're looking for is in the run into that rejection block or old high, we're looking for symmetry in form of market profile and narrative between Eurodollar, which is our reference asset, and 10-year T-note, which is our comparison asset. If we can identify symmetry, then that increases the odds or the likelihood of a continuation trade. Now, again, that does not mean because that increases the odds, we just go and take trades, right? There's still other filters we have to go through. This is just one of those filters. But if we have a situation where, as we trade up into an external range liquidity pool, we see that lack of symmetry in terms of market profile or price delivery, then that creates an asymmetrical signal. Now, going back to our initial understanding of institutional order flow, when a market is institutionally sponsored, we tend to see that liquidity reflect across other correlated asset classes, which is where you get correlation. That's where the whole concept of correlation in price, that's where it comes in. All right, so when we start to see that asymmetry as we reach a liquidity pool. Now let's go back to the concept of a liquidity pool. I could barely talk, Jesus. Let's go back to I'm so excited to go over the presentation for today. I do apologize. But let's go over the concept of a liquidity pool. Now, what is a liquidity pool? Again, remember, higher time frame liquidity pools, they come in form of rejection blocks, which is the bodies of the candle, or old highs, right? For a bullish example. So if we go back to the concept of a liquidity pool, we understand that liquidity pools are areas where institutional flow will dump positions. They would square positions. They'll be counterparty, right? So typically when price trades into external range liquidity pools, you either get a trend continuation or you get a mean reversal market. So you get a situation where the market just reverses from that level, or potentially you could even get a retracement, right? But again, how can we determine the likelihood of any of the four market profiles? Now, if you actually watch my live streams or if you've listened to any of my past commentaries, right? I always talk about the fact that in the run up into a liquidity pool, it is easier to trade. And the reason why it is easier to trade is because we anticipate that the market profile would either be a retracement profile or an expansion profile. If it is going to be a retracement profile, we simply identify daily discount rates where the market should expand from. And once we start to see that expansion, we just align with that expansion, right? But now, when we trade into pools of liquidity, it becomes a lot more difficult to kind of predict what the market will do next. And the reason why is because after we meet an objective, there are so many profiles the market can follow. The market could consolidate for extended periods of time. The market could reverse altogether, like in this example. The market can break out and just continue to trade higher. Or we get a retracement, that then continues the overall trend higher, right? So the obvious question is, how do we go about anticipating what market profile could be potentially offered after the run through either the rejection block or the old high? And this is where symmetry, the concept of symmetry, comes into play. And this is why I think this is really, really crucial, because what we're looking for is we're looking for signs of strengthening order flow. Again, we're going to talk about that on the next video, right? Which aka leads to trend continuation or breakout, right? But when we get into those pools of liquidity, the first thing we do is we stop taking trades, right? That's the first thing, because when the market is at pools of liquidity, it generally is a low probability scenario, right? So that's rule number one. We're not looking to take any trades. Now, what we do here is we're conducting our assessment. And what are we looking for? So again, going back to our slide, what we're going to do here is we're going to use an example for a bullish program, right? So in a daily buy program of a reference asset, in this example, we're going to use euro. The first thing we do, of course, we're not taking trades, we're only conducting our assessment. So the first thing we do is we conduct a 20-day look back, right? So from the last complete trading day, we go back over the last 20 trading days, right? And what we're looking for is we're looking for symmetry or asymmetry between our reference asset, in this example, euro dollar for buys, and our comparison asset, in this example, 10-year T notes. So what are we looking for specifically? We're looking for 4 confirmations, right? 4 confirmations of asymmetry. If we cannot identify either of these confirmations for asymmetry, then that creates a possibility of a trend continuation. Again, we're going to talk about trend continuations. We're going to talk about protocols we're looking for trend continuations, right? But again, when the market trades into a higher time frame external range liquidity pool, this is where we start to look for signs of either an exhaustion. Again, we're going to use this concept in combination with other concepts, or signs of continuation, or after we see a potential reversal or quarterly shift in price action, how can we establish that quarterly shift as the actual new trend, right? So these are topics that will be assessed on our the subsequent videos, right? So what we're looking for is in a bullish order flow, when we expect to run up into a buy side liquidity, a general liquidity, right? What we're looking for is we're looking for behavior of our comparison asset in the run up to that general liquidity on our reference asset. So what that means is if we're expecting euro to trade higher into a buy side liquidity pool, and we start to see euro trade up into that buy side liquidity pool, what we're looking for is we're looking for the price behavior of 10-year T notes as euro starts to trade up into that buy side liquidity pool. And what we're looking for is, number one, we're looking for a clear sell side liquidity objective. So if we have a situation where euro dollar trading up into a buy side liquidity pool, 10-year T note has a clear sell side liquidity. So maybe clean lows or just levels where lows or volume balances where it kind of makes sense for T notes to trade down into, then that creates a potential for bearish expansion on T note. Now, if we get a situation where T notes are bearish, that's not really going to allow for a really bullish euro dollar. So that creates asymmetry, and that creates a higher probability of a trend exhaustion. So the first thing we're looking for is, we're looking for, does our comparison asset have a clear sell-side liquidity objective? That's number one. Number two, do we have a bearish daily time frame structure? So can we identify bearish expansions, aka lower lows and lower highs, as your dollar trends higher? Because if we have a situation where your dollar is trending higher into a buy side liquidity pool, right? So what I'm probably going to do here is, I'll just take a blank chart so we can do some drawings on the video, right? So I want to make videos like this just really short, and hopefully we can churn out a lot more of this, because these are not the main topics. We already covered the main topics on the last video, right? So this is just explaining specific protocols, right? So if we have a situation where, going back to protocol number 2, right? So first objective is, if we expect high prices in euros, so let me just do this real quick for ease of annotation. So we have euro dollar on the left side, right? And we have a divider, and we should have 10-year T-note on the right side of our chart, right? So if we have euro dollar on the left side of our chart, 10-year T-note on the right side of our chart, right? Now, again, the example is that we're looking for bullishness on euro dollar. We're expecting high price on euro dollar. So if we have a clear buy side liquidity pool on euro dollar, and we expecting euro dollar to trade up into that buy side liquidity pool, what we don't want to see is, we do not want to see a clear sell side liquidity objective. You can see these are clear those on here. If we have a clear sell side liquidity objective on 10-year T-note, then that creates the possibility of a bearish expansion, in which case, if we start to see bearishness in T-note, that's not really going to allow euro dollar to continue to trend higher. So that creates a situation where we see exhaustion of institutional flows, because we're not seeing bullish sponsorship on T-note, which should be correlated asset classes. So that is number one protocol. Number two is, we're looking for a bearish daily time frame structure. So we're looking for a bearish expansion when euro dollar is trading higher. So again, going back to our initial example, if we have a situation where we're expecting high prices in euro dollar, right? What we don't want to see is, we don't want to see 10-year T-note expanding lower, because if we're starting to see 10-year T-note expand lower, especially if that comes after we take out a higher time frame buy side liquidity pool, that creates a low probability for continuation on euro dollar, because we're seeing 10-year T-note already trade lower, right? At the time euro dollar is trading higher. So what we're seeing here is, we're seeing bearish institutional flows into 10-year T-note at the time euro dollar is trading higher. So that feedback is, potentially we could see institutions, as they take profits up here, we could see new institutional sales coming to the marketplace, because that already is being reflected via T-note treasuries, right? Again, this is why intermarket analysis is crucial for high probability traded market conditions. Number 3 protocol is, we don't want to see consolidation and or downside expansion at its daily buy side liquidity. So again, it's the same concept. If we're bullish in euro dollar, we're expecting potential bullishness in euro dollar. We don't want to see signs of bearishness on treasuries, because that creates a disparaging market profile. It creates a condition that is not conducive for a trending market environment. So what we don't want to see here on 10-year T-note or any of the interest rate chart is, we don't want to see consolidation, right? So we don't want a situation where 10-year T-note takes out its buy side liquidity and then starts to consolidate, right? Because that shows a lack of sponsorship, right? Again, all the examples I'm giving here are just examples that shows a lack of sponsorship. So if I was a situation here where euro dollar starts to trade higher, and at the time euro dollar starts to trade higher, T-notes are consolidating at its high, at its target objective, that could create a situation, again, even though this could end up being potentially maybe a breakout, right? That just the fact that we're consolidating at a counterparty objective creates a situation where we're no longer seeing institution sponsorship on 10-year T note. So the fact that we're seeing euro dollar run higher is indicative of the fact that once we clear out that buy side liquidity, we're going to see a lack of that institutional participation. So that means continuation trades, they're a no-go. You're not meant to take continuation trades. That's what that means, right? So finally, protocol number 4 is interest rate SMT and bearish expansion after running buy side liquidity. Again, it is kind of similar. You can actually blend all of them together, but what we don't want to see here is we don't want to see bearish SMT at the highs after we take our buy side liquidity and 10-year Chino. All right, so bearish SMT with what? Bearish SMT with the other interest rate charts. So 30-year T notes, 5-year T notes. What we don't want to see is we don't want to see 10-year or any of the treasuries trade up into its daily buy side liquidity pool, create an SMT divergence, and then start to expand lower. If we see that as euro dollar starts to trade higher, that creates a lack of institutional sponsorship as we trade through that buy side liquidity pool. So we can actually see clear examples here on euro dollar. So between Monday 8th of September 2025 to Wednesday 17th of September 2025, we had a situation where we initially saw a bit of a consolidation on euro dollar, and that was just mainly due to the fact, if we go back on T note, we saw consolidation in euro dollar, and that was mainly due to the fact that we on 10-year T note, again I kept just missing. That was mainly due to the fact that on 10-year T note, we were starting to see heavy consolidations also on T note. Now here's the deal. As we run up into that buy side liquidity, you can see here we break out of that consolidation. We have the fair value gap bullish order block down here. The market retraces down to that fair value gap bullish order block. We start to see that bullish expansion, change in state of delivery, and we see, of course, that bullish sponsorship going into the next training week. Now, here's the deal. As we run, or as the market trades into that daily rejection block, bullish rejection block, we stop taking trades because at this point here, we don't know what is going to go on. We could have a situation where the market maybe aggressively sells off, or we could have a situation where the market just continues to trend higher, right? So what is certain for sure here is we're not so sure of the market profile after. So this is where we begin to conduct our analysis, looking for signs of either an exhaustion or a continuation, right? Or we wait to establish a daily reversal, right? Now, you can see here, as we start to run higher into that buy side liquidity pool, let us take a look at what 10-year T-notes was doing. Now, remember the correlation between euro dollar and 10-year T-note. If we're expecting higher prices in euro, we want to see that followed with higher prices on 10-year T-note. If we're expecting euro dollar to trade up into a buy side liquidity pool, we also want to see treasuries trade up into buy side liquidity pool. That is a healthy market. That's a market that is institutionally sponsored. Now, between 8th of September to 17th of September, we had a situation where euro dollar was running higher into the buy side liquidity pool. But then if you go and take a look at T-bonds, it already had traded up into the buy side liquidity pool, right? This major high up here, right? The rejection block. Again, we don't need the high. Rejection block is enough as a target objective, especially when we're focused on higher time frame levels. You can say the same thing down here, right? Rejection block, the market never really trades down below the low down here. So if you were waiting for a sweep of that sell side liquidity below the candle wick low, you're missing that. You're missing all of this run higher, right? So we don't require highs and lows for our target objective, right? Our zone starts from the rejection block all the way up into the highs and or lows. Now, if you watch 10-year T-note 10-year, right? I'm not going to talk about the SMT divergence, but if you just watch 10-year T-note 10-year, initially we start to see the market run higher. And this was around 3rd of September. So if you look at price from around 3rd of September, especially in euro dollar, we're not really seeing that much of a one-sided price delivery compared to T-notes, right? But now here's the deal. As we run up into that target objective on 10-year T-notes, leading up into this run here on 17th of September, right, which is where we trade up there, you can see at the time we were bullish on euro dollar, we're actually consolidating on 10-year T-note. Now, not only were we just consolidating, if we're consolidating down here, then that kind of makes sense, right? Because we're not doing so at a premium array. If we're kind of consolidating down here, right, then again, still, that's still okay. We could still anticipate the possibility of high prices in euro dollar because we're doing so at this kind of a deal range, number one. We're not doing so at a buy sell liquidity or high time frame premium at the moment. But if you look at this trend here, we already met our drawn liquidity. We started to see the market consolidate. So why is euro dollar trending up and a 10-year T-note not trending up? So what we're seeing here on 10-year T-note is we're seeing a market exhaustion. We're seeing a consolidation profile. A consolidation as a sign of a lack of a bullish expansion. If we're seeing a bullish expansion on euro, a high probability profile for a continuation on euro dollar in a bullish expansion is also wanting to see a bullish expansion on T-bond. But if we're seeing a bullish expansion on euro dollar and we're not seeing a bullish expansion on treasuries, but instead we're seeing them consolidate, especially after trading up into this buy-sell liquidity pool, that shows a lack of institutional sponsorship. Because what we have here is we have a disparity between our reference asset, which is euro dollar, and our comparison asset, which is treasuries, right? And what you get after is you get a reversal. Again, the goal of the video is not to focus on the reversal. The reversal is not the point of the question. We're going to talk about market reversals in the third video of this 3-part series. But for now, what we're looking for is we're looking for signs of trend exhaustion. Now, here's the cool thing. This is not only applicable to highs and lows. This is also applicable to internal range liquidity, just like we saw down here. If you remember down here on in euro dollar, I believe, right? This reversal kind of caught us off guard. So initially we saw the market trade lower. At the time, we were all expecting euro dollar to trade lower, and we kind of lost some money down here because we were not anticipating that reversal, right? Now, if you go and do your study, you would have seen the same thing I discussed on the video in here. But the example I have here for internal range liquidity is a bearish example, and that is the price profile between 6th of November 2025 to 14th of October. Sorry, 6th of October 2025 to 14th of October 2025. All right, so now let's talk about internal range liquidity pools, because we already addressed we already accounted for external range liquidity pools on the higher time frame profile. Now, for internal range liquidity pool, what I decided to do here is I decided to use a bearish example. And when we talk about internal liquidity pools is quite different to external liquidity pools. So let me just explain real quick. Liquidity pools would always rest at areas of inefficiencies or areas of a cluster of willing market participants, right? So this is where the concept of equalizing lows comes into play, because when retail spots equal highs in the marketplace, they view that as resistance. And because retail views that as resistance, any subsequent trades after would have that equal as a level for protection, aka stop loss, right? So what is a stop loss in a short trade? That's a market order to buy, right? So that's a buy limit order, right? So what you have here is when you have obvious levels of retail resistance, that creates a pooling of buy sell liquidity, right? So that creates an objective for the market to trade into them. That's where you get the concept of liquidity pools. Now, let's talk about internal range liquidity pools versus external range liquidity pools. A very brief, just a summary of them, right? So again, when we talk about liquidity pools, it is all relative because the market is all valued relative to dealer ranges. External range liquidity pools are liquidity pools that would form outside of your dealer range, right? So this is where you have the concept of your rejection blocks. In this example, a bearish rejection block and an old low would constitute as your external range liquidity pool. And for your range high, a old high and also a bullish rejection block would also constitute as your external range liquidity pool. Now, any inefficiency inside of this range or any short-term high and low would constitute as your internal range liquidity pool. So if you have a bullish value gap down here that is a bullish fair value gap is an area where there was a lack of sell side delivery, so that becomes a sell side liquidity pool, right? If you have an old low down here, that also becomes a sell side liquidity pool, right? So the concept with our protocol number 2 for high time frame internal range liquidity pools is we're looking for trend exhaustion. Now here is how we apply that concept. It is just a bit different to the first protocol where we're applying for external range liquidity pool. Now again, just a refresher, going back to the first protocol, we apply the concept as soon as current market price trades up in a bullish daily program. As soon as current market price trades up into a bullish rejection or an old high, we start to look for signs of trend exhaustion. Now, for an internal range liquidity pool, as soon as the market trades in a bullish order flow, as soon as the market trades through equilibrium into premium, we start to look for that as the market runs into a premium array, and vice versa for a bearish example. So in a bearish example, as the market trades below, let's assume that this is the equilibrium of that daily range. If we're assuming that we're looking for shorts up here, we continue to trade shorts until the market trades through equilibrium of that daily range matrix. Why? Because in a bullish order flow, you're likely to get bullish expansion from discounts at discount arrays, right? So as soon as the market trades below equilibrium, what we start to do here is we start to look for signs of either weakening order flow or continuation, right? So again, what we're looking for here is as soon as we trade below equilibrium of that daily range, we pre-identify all our areas of sell side liquidity. So that would come in form of an old low inside of that daily range, a bullish fair value gap, and or a bullish order block, right? So as the market trades below that old low or trades into that fair value gap or trades into that bullish order block, we're looking for disparity between our reference assets. So if we have an example here on euro dollar where we assumed bearishness and we're short on euro dollar, and as the market trades below the equilibrium of that daily range, we trade below sell side liquidity pool. The first thing we do is as we trade down below that sell side liquidity pool, can we confirm on a correlated asset, in this example, 10-year T-notes? Can we confirm that at the time we traded below that sell side liquidity pool, which is internal range liquidity pool, 10-year T-note was also trending lower? If 10-year T-note was trending lower, then that's a high probability for a continuation trade, right? So you go and apply other protocols, concepts like inversions and all of that to find new shorts because you have the confirmation of order flow. But if you start to get disparity, so if you start to get a situation where as euro dollar traded below that internal range liquidity sell side pool, either 10-year T-note was trending higher, right? Or we had a sell side liquidity pool on 10-year T-note and we already traded below that sell side liquidity pool and we're starting to consolidate. That does not create a high probability market condition for euro dollar bearish continuation. So in this example, even though initially up here, we're looking for the market to trade down into sell side liquidity with the expectation that we could possibly see a shift in order flow as we trade down into a discount. When we start to see that asymmetry where euro dollar is trending lower, right? T-bonds are not trending lower. They're consolidating at a sell side liquidity pool, or they're seeing a bullish expansion, right? Or going back into the other example, we're seeing S&T divergence down here. That's not a market that wants to be aggressively bearish. That's a market that is showing signs of potential bullishness. And what that means there is, in this example, we're not expecting the market to take out external range a sell side liquidity pool. We're looking for signs of a reversal. And if we get a change in self-delivery with that confirmation, that leads us to number C in our protocol, which is using daily price profile symmetry to establish daily reversals and confirm new order flow. So we're going to talk about that on the third part of the series. But going back to trend exhaustion for internal range liquidity pools, again, what we're looking for is we don't want to see clear buy side liquidity objective on a comparison asset. In this example, that would be 10-year treasuries. We also don't want to see a bullish daily time frame structure. So we don't want a situation where as euro dollar trades down into an internal range also liquidable, we do not want to see higher highs and lows on treasuries on the daily time frame profile. And the same thing applies for consolidation or bullish expansion after running a sell side liquidable, and also SMT divergence and bullish expansion after running sell side liquidable. So a very good example would be between 6th of October 2025 to 14th of October 2025, we had a situation where we had a defined range on euro dollar. So that defined range on euro dollar was the low from 1st of August 2025 to the high from 17th of September. Right? So that is our daily range. Now, if you take our daily range and you overlay the equilibrium of that daily range, what you can see here is up here, shorts are ideal, right? We get really nice shorts here, really nice shorts here. And then as soon as we trade and close through the it does so in this candle. As soon as we trade and close through the equilibrium of this daily range, we no longer hold a really aggressive bearish market sentiment. And the reason why is because we are looking to confirm, is there a possibility for a continuation of the trend? Or is there a possibility that we see a fair bit of reversal, or even maybe a consolidation, or even maybe a retracement down here? How can we predict that? Again, we go and compare against 10-year T-notes. Now, the way we compare is we conduct a 20-day look back. All right, so what I would do here in this example, my reference would be 14th of October. So if I just use a replete tool like this and cut off from 14th of October, all right? So let's assume we're trading this trading week. We have a situation where we've traded below equilibrium of this range low and high. We've ran below sell side liquidity, and we've traded down into a bullish buy side and balance sell side efficiency. So we have two possibilities. Either the market continues to trend lower and takes out sell side liquidity, or we could see consolidation down here, or we basically expect similar conditions to up here, right? Where the market can behave in any of the four market profiles. It could expand right through, invert all of this, and take out sell side liquidity, or it could consolidate for an extended period of time, or we could see a retracement that then continues the expansion lower, or we could see a reversal altogether. So how do we determine what is more likely to happen? This is where we start to apply the daily price profile symmetry concept, right? So what we're looking for here is we're going to look at treasuries and look at what treasuries have been doing, or 10-year T-notes, right? So if I go into look at 10-year T-note, 10-year, you can see at the time, so at the time where we saw euro dollar, going back to our example, at the time where we saw euro dollar trending lower, taking out sell side liquidity, and inside of that buy some balance sell side efficiency, all of this run lower was not met with a bullish, a bearish expansion on treasuries. Instead, we were actually bullish, right? So because we're seeing bullishness on T-notes, there is no clear sell side liquidity in T-note. There's a clear buy side liquidity in T-note actually, which is up here. That does not create a conducive market for euro dollar to continue to trend lower, because we have a situation where there's a strong probability of 10-year T-note trending higher. So how do we behave in this situation? What we do here is we did nothing, right? We did nothing because there really is nothing to do. What we're waiting for is we're waiting for a change in state of delivery. Now, of course, here you can see a bullish candle on Tuesday, but again, we're waiting for that confirmation, which is what you get here on Wednesday, right? And either Wednesday or Thursday would have been a good day to go and trade longs, right? And looking for the market trade up into premium, possibly trade up above the side here because of what we kind of expected on 10-year T-note. But now what you can see here with 10-year T-note is we have met again daily buy side liquidity in 10-year T-note. And if you go into look at euro dollar and see where we're at on euro dollar, we're currently at a premium. So what do? Do we continue to hold a really strong sentiment of bullishness in euro? No, right? What we do here is we start to hold less of a bullish sentiment on euro dollar because there is no more bullish room for expansion on 10-year T-note. The only time that would qualify is if we trade and close above this high here and continue to expand higher. So if we have a situation where we just get bullish expansion on 10-year T-note higher, then we can kind of qualify that euro dollar should see a bullish expansion. But again, remember, in general, as we trade into the opposing part of a PDA matrix, we're not looking to aggressively trade in the same direction. We're looking for inversion. So what you're looking for here on euro dollar to kind of qualify confirmation of bullishness in price action is you're waiting for that inversion, because between this high here and the slowdown here, if you wanted to be a buyer, the best time to do so would be at the discount of that data range. You can see here we are at premium. Because we are at premium, we're waiting for either retracement back into the discount, which should be confirmed with structure analysis on 10-year T-note, right? That should kind of be confirmed with structure analysis on 10-year T-note, where if we're expecting bullishness on euro dollar, any retracement down into this fair value gap should kind of be met with just no willingness whatsoever in 10-year T-note to want to retrace lower, right? Because if we see a really strong retracement from that high there, that just lowers the probability, because we could get a retracement, reversal, consolidation, whatever. So we're looking for signs of just bullish expansion to create a scenario where any down candle here would be seen as a chance to go long, because we can already see from treasuries that institutions are net long. They're accumulating longs. But in this example here, we're already at a buy sell liquidity. Again, like I talked about with our example, we don't want to see bonds already at a buy sell liquidity. We want to see a clear objective for it to reach up into. In this example here, there's no clear objective for it to reach up into, because we already traded up into that objective, which kind of lowers the probability for a continuation higher on euro dollar. So again, this is how you can utilize daily price profile symmetry for trend exhaustion at external range liquidity pools and also internal range liquidity pools. I'll see you in the next video, where we're going to talk about the daily price profile symmetry and its application for trend continuation. So how can we determine if the market is more likely to continue to see a breakout and follow through after that breakout as the market reaches for external range liquidity pools? We'll talk about that on the next video, and in the meantime, trade safe for now, and I will catch you in the next one. Peace.